Hello, Maverick Traders. This is Rob Reinhold. I'm joined by Mr. Darren Fisher, and I cannot believe that it is officially July. The first 6 months of the year are gone, so put those in the book, and let's take a look at last week. Now, last week, let's talk about the week itself. And then I want to talk about the quarter, and then I want to talk about the first half of the year. So just looking at last week, those last 5 days, we basically gave back half of last week's 6% bounce. So we got this big bounce off the bottom. It closed really strong on last Friday, and then it was nothing but down for 4 days out of the week. And then we got a little bit of a rally on Friday. We saw this on Friday, and I actually talked about this possibility. If you listen to my end of day video on Thursday, I talked about how there was some really intense selling on that Wednesday and Thursday, and it to me just seemed a little weird. And I had the thought of what if it was end of quarter window dressing. Now, if you don't know what this term is, typically window dressing is when a firm at the very end of a quarter, right before they have to publish all their holdings to their investors, they'll go out and buy all these stocks that people want them to own. So it looks like they owned it the whole time, but they didn't really own it the whole time. I actually wondered if maybe it was the opposite this time, where they were selling all the things that they didn't want to show people that they owned. And I really said it's going to be very interesting to see what happens on the first day of the next quarter. And we got a little bit of a buy here. Now, look, who knows if that was really the case? I am not bullish by any stretch of the imagination. But to me, the selling this week seemed like it was being driven by more than what was happening out there in the world. This last quarter was the worst quarter since the first quarter of 2020. Just think about that. That was when COVID hit. That was in the depths of COVID. That's how bad this quarter was it was as bad as that quarter. And the first 6 months of this year were the worst first 6 months of a year since 1970. So we're going back 52 years since we've seen a first half of the year this bad. So I just wanted to share those with you to really show you the magnitude of what we're seeing here lately. This week, I kind of felt like everything kind of changed. The bond markets, they tumbled. So we've been seeing bond markets and bond yields go up and up and up, inflation going higher, pushing up interest rates, the Fed getting more and more aggressive that pushed up interest rates. We've gone from 3.5 to 2.8 in less than 2 weeks. That's a big move. And a lot of other things have happened. Copper and iron ore are down 30% from recent highs. Gold's down 10%. Silver's down 20%. Oil's back down into the low 100s. Nat gas has come down like 50% from its highs. I think we're starting to see the inflation bubble popping. And I shouldn't really call it the inflation bubble, but there's a lot of signs out there that inflation is coming off. Now, look, that's not a great news. Look, I know we all want inflation to go away, but what that's telling us is it's going away because demand is being crushed. And Darren, you talked about demand destruction a lot over the last couple of months. I think that's what we're seeing. What do you think?
I think that's exactly what we're seeing. You see it. We've been pounding this. We've been pounding the drum on inflation for 2 years. We've been talking about demand destruction. It's here. People are having to make decisions about do they buy groceries or do they buy gas? This is so 1970s. It's unbelievable. You go back and see some of the political cartoons from that era, and it's that thing. Please just, it's the wife with 2 kids asking her husband, please, can I have $5 for food? I have to get gas. It's such a sad situation, but I think that's where we are, and I think manufacturing companies are seeing it. We're seeing this in materials. Copper and iron ore down 30%. Those are basic inputs to a lot of different things. So if the companies that make stuff are seeing a downturn in demand, or their input costs are too expensive and they know they can't pass that on to the consumer, they're gonna have to scale back. And I see an opportunity here for margins to get even more squeezed, because the producer price index has been going up faster than the consumer price index. So when that happens, that's going to squeeze margins right there as well. This is a conflation of I mean, this is the perfect storm for a bear market and a recession and inflation all at once. It's unbelievable. I think 50 years from now, this is going to be written about and studied by economists just as much as the Great Depression was. I think that's the kind of situation we're in.
I think it's going to be very, very interesting looking back on this in history. So my take on this, Darren, and we haven't had a chance to talk about this before, is that so we've been getting these inflation numbers that were really hot, and the Fed has tried to like, hey, we're serious about fighting it. Here's the thing is that a lot of these things that I just talked about, these are leading indicators. Here's the problem. It's not going to show up if we are past the height of inflation. Inflation isn't going to come down for a couple months as these things work their way through the system. So I feel like the market is really in a tough spot here because you've got this one side is like fight inflation, raise interest rates, slow things down. And then it's slowing down and they're saying we can't back off until it slows down. And I feel like the market's like, hey, it's slowing down. Bond yields went down to 2.8. And I don't think the Fed is going to listen to it. So it's very interesting area I think we are, whereas the economy is slowing, inflation is still high, and I don't think the Fed can back off until they actually see the results, and it may be too late for that. What do you think about that, Darren?
Yeah. So think of it as we're talking about the difference between speed and acceleration. Okay. Early on, we had accelerating inflation. So it's like getting in a car going from 0 to 60 as fast as you can. Well, once you hit that, you're through your power band. You can still end up going faster, but it's going to take you a little more time than to go from 0 to 60 than it will from 60 to 100. Do you understand what I'm saying? Inflation, I think, is still going to increase, but it will just increase at a slower rate, and the Fed has to fight that. And they're still behind the power curve. We should have had 100 basis point raises, for the past year, and they haven't done that. And now they're in a situation where they're going to try these measured increases, and they're still going to be behind. They're still going to be behind that curve. And I mean, this is one of the things we probably could have ended this all in 6 months if they had been more aggressive, but they're just out there. They're trying to not step on so many people's toes. That's not what we need right now.
Yeah, it's definitely a tough situation. If you look at the economic reports, it's kind of showing like people are hesitant. Consumer confidence falls. We got ISM manufacturing missed at 53, but the new orders are below 50. Any reading below 50 is a recession. So that's a big deal there. And you can see we got PCE inflation a little bit less than expected, but still hot. So the market had a lot to digest, and it really wasn't until the end of the week that the market actually found some buyers, because all week long, anytime there was a rally, it got slapped down and slapped down hard. So if we took these numbers on Thursday, it would have been down 4-5% week. We actually bounced back quite a bit on Friday. So if we take a look at these candles, you can see we rallied off that bottom in middle of June, came up to that 390, 395 area, hit our head against that and pull back down. But you can see Thursday was a pretty serious candle because it gapped down and it actually went up for the day. It was a green candle, and it was followed through on Friday, closing up near the high. If you talked to me on Thursday, I would have told you, hey, you know what? It's very possible that we might come down to that June low and break it and pierce it because the selling was that intense. I think at this point, Friday's candle is telling me we are probably in a low base. We're probably going to run up to that 390, maybe 395 area, and we might go down to that 370 area. I think that's where we are. I think we're stuck in that range. If you take a look at the Qs, really same thing. We rallied up, hit our head against that moving average, came down. As you can see, Friday's candle is not as impressive on the Qs as it was on the SPY, but I still think we are just in a low base. So 270 at the low, 295 at the high, and that's just where we are right now. So I do think that we have put in a credible bottom. I think this bottom that we had in June is likely to hold for a little bit. I don't think that is the ultimate bottom, but I could easily see us doing like a U shape here where we just bottom out and we sit down and we just go nowhere for a while until we have the breakout up or the breakout down. What do you think, Darren?
Right. I found it very difficult to trade this week. I said last week that I wanted to see 2 confirmation days down. And you can see that Tuesday would have been our first, true confirmation day. But we fell so hard and so fast that I was very hesitant to get in. I mean, it was one of those things where that move down on Tuesday could very easily have been retraced. And then we get a doji on Wednesday. We get a doji on Thursday. I wasn't confident entering any position right there, and I'm glad I didn't. I so wanted to get more short this market, but I just didn't find this week to be a very good entry. And I'm glad I didn't, because Friday, I would have been sitting on some losses right here. So I kind of in agreement. I want to see if we get a follow through Monday and Tuesday from Friday. If we do, then I think your case for a low base is good. But I'd look at the volume, and I could very easily see us heading back down Monday and Tuesday as well. So I'm going to be wait and see probably till Wednesday to see if I want to trade anything next week.
Well, I do have to remind you, markets are closed on Monday for 4th of July. So yeah, Tuesday, Wednesday.
I'm glad you said something, because I'd have been sitting in front of my computer wondering why I wasn't getting any quotes.
I think you would have noticed 4th of July, actually. I think you could have made that case on Juneteenth or like when it's closed for President's Day, but I don't know. 4th of July, that's a tough one to miss.
Yeah, you're right. That would have been interesting.
If we look at the VIX really didn't do anything this week. And the reason why I think that low we hit in June was a credible low that's going to hold for a little bit is that we did get that spike in the VIX to these panic levels of 34. And whenever we get to those panic levels, we actually usually get a pretty durable bounce off that. So that's why I think that we have bottomed in the short term. But like I said, I am not bullish in any way, shape, or form. I'm just no longer as bearish as I was. So let's take a look at what is going to be happening this week. So as I mentioned earlier, the U.S. equity and bond markets are closed for the 4th of July. So we have Tuesday through Friday trading. And I think this is going to be a choppy week. I think we're going to have one day up, one day down. And I think by the end of the week, we've not really gone anywhere, maybe drifted up a little bit, but it's going to be choppy. And I think that's what the trading is likely going to be for the next couple of weeks. Wednesday, we've got ISM services, and Friday, we have payrolls. They're expecting 250,000 jobs, 3.6, 0.3 wages. I don't think this number changes what the Fed's going to do in 2 weeks at all. And so I don't think there's going to be all that much movement off of this payrolls report. So here's our outlook. We are still at a -3. The technicals say that we need to be at a -3. We are trading below our 20-period moving average, below our 50, and the 20 and 50 slope is still moving down. With that being said, I'm just not as bearish as I was just a couple weeks ago. I think that low that we hit in June is going to hold for a while. So for me, I'm looking at this saying, okay, what's my range here? My range on this is, 365 up to 390, 395 on the spiders. So we have to make sure that we're not overly bullish and overly bullish at this moment in the markets. I've got a 0 on the week. I actually probably would be tilting that a little bit more towards a +1. I mean, as Darren said, if we get 2 up days on Monday, Tuesday, we might have a little bit better bounce. If we give everything we got on Friday up on Monday or Tuesday, we're probably going to retest Thursday's low. But ultimately, we don't think we're really going to be going anywhere. So let's jump into the sectors.
Yeah, the sector story is really kind of interesting right now. And we're going to see you've got utilities and energy are the ones that perform the best right there. I mean, for utilities to go up 4% in a week, I mean, that's a very big week for that sector. It just doesn't move a whole lot. But then you can see definitely the weakness in, for the sectors, communication services, consumer, tech, materials. Nobody wants to be in there. Everything else is just kind of in pause mode. for anything else. Real estate, barely moved. Industrials, considering the volatility we've had in the market, down 0.81%. That's barely a blip. Financials down 1.1.5, considering the way they've moved before that. I mean, it's barely a blip. So there's definitely some strength out there in in two key sectors, but there's also a lot of good shorts in those four sectors you can see right there. So let's take a look at everything individually here. Utilities, I'm at a +1 on, and you can see the move that they had this last week is good, but they've expended a lot of energy making that move for the past 2 weeks. So I think now they're above the 50-period moving average. I think we're going to see some, still more to the upside, but I think it's going to be more sedate than what you saw the past 2 weeks. Moving on to communication services here. I'm at a -2, and we're finally getting to the point where you don't have to go on gut feelings with some of these sectors right there. You can see we came up to hit the 20-period moving average and immediately came down. I mean, this is, you can see the trend line right there. It's following that trend line so well right now, and we're near the bottom of that as well. I mean, this is shaping up to be a descending triangle, even with Friday's move. And I think the next move, we might go up a little bit to that 56 area, the 20-period moving average. That's not very far. And I think from there we roll over. Communication services just not looking very good. Real estate, we took a look at real estate. They actually held some gains. We got above that 20-period moving average right there. You might see some resistance at 42, which is one of the reasons I have a 0 on it. I think we base to the side, and once we can try to build some interest in real estate, I think we have a possibility of getting back above that 50-period moving average, and real estate starts looking a little bit better. But right now, I'm in a wait and see mode on real estate, and we're to 0. On to industrials. I'm actually at a -1 on industrials. We didn't make up as much ground as we could have on Thursday and Friday right there. You can see that. We definitely have some serious resistance right there at the 90 level. If we can float up there, maybe, I think we roll over. Honestly, that's what I think. I think we might float up a little bit this next week, but then I think we roll right over. We'll see right there. So I'm at a -1 on industrials right there. Healthcare, looking pretty decent. We actually regained our 50-period moving average right there on Friday, even though we had Tuesday was another good. We had a nice, really good bounce right there. So I'm at a +1. I think we see some minor floating up movement in healthcare. You take a look at the individual industry groups in healthcare, you definitely pick the winners and the winners out of there. And that's where I go. Looking at biopharma within healthcare, I mean, that looks really good. Let's take a look at some of those. Contrast that with financials. -2 on financials. I think we had some relief. We put in that bottom. We went up and hit resistance at that 20-period moving average and rolled right over. Did have a decent candle on Friday. A pretty good candle. We were up 1.37%, just on Friday alone. But I think we see continued weakness in the financial sector. So midterm, I'm in a -2. Consumer. That's another one not looking too good for me. I'm in a -2. I mean, this is even more bearish than financials is. We barely made up any of the gains. You can see Thursday's candle. We hit support there at about the 135 level right there, and then came up. So we closed at about 140. But this just long term, everything looks weak. I mean, there's about 5 charts that all look the same like this. Tech. Here's another one. I mean, you can basically mirror the chart on it. I'm in a -2 on tech as well. We did put in, we didn't come quite down as much to hit previous support. So there is a little bit more strength right there, but not a whole lot. I mean, it was pretty decent doji we had on Thursday, and Friday's candle not looking as good as some of those other ones. So definitely -2 on tech. Materials. You can see that this is even more. You could make me a case for a -3 in materials, and this has fallen so hard, so fast. I mean, we made a lot of good money last year in materials, and really hasn't materialized this year. And we can see that this is demand destruction right here. And this is exactly what I'm talking about. We're at support right now. Had a decent candle on Friday, but you can see we pierced way down below support. But we had that long lower shadow right there. So I think this one rolls over even sooner than a lot of other ones. Finally, energy. We've been bullish energy. We've made a lot of money on energy. Now's not the time to be trying to get back in massively bullish energy right now. This, again, not as much demand destruction as you saw in materials, but it's still there. We're a long ways away from that 20 and 50 period. You can see the 20 crossing through the 50 right now. That's definitely bearish right now. I'm going to zero. I think we base here. I think this is an opportunity for energy to just base, let the moving averages catch up with it, establish some support, and then move on from there. We'll wait and see what happens. You could also make me the case that we go down further from here as demand continues to get eroded. So looking at all the sectors together, you can see we've got 5 in the -2 category right now: materials, tech, consumer, financials, communication services. Industrials looking a little bit better, but it's still in a -1. 0 for energy and real estate. And the only things that are looking good, in my opinion, right now on the long side are healthcare and utilities. So let's take a look at some picks right here. So last week in utilities, we were sideways or long CEG. Had a little bit of movement there, even though the utility sector looked pretty good. CEG was down 2.83%. So if you want to bail on that trade, that's completely understandable. But I think that if you wanted to stay in, this could catch a bounce and you could get out, on that sideways trade. So this week we're looking at Next Era Energy, NEE. We've traded this one in the past and it was looking pretty good. Especially the upside. We put in a nice base right there at the 20-period moving average, and we broke through it, broke through that support. So there's probably going to be a little bit of resistance up there at the 81 area, but if we can break through that, if you've got a 8-week horizon, you could see it get back up to that 86 area. So this is definitely one that I would want to take a look at. And if you want to wait until it breaks through 81, I wouldn't fault anyone on that as well. So you'd probably play an 80, 85 bull call spread would be something that I would take a look at. This one, though, I would probably go out. You could play it in July. Yeah, that one is good. You might want to take a look at how much premium you can actually pull in on those 85s. But I would also look at August. That same trade for August is going to give you a lot more time. And I think you're going to get a lot more premium from those August 85 calls. Would also be something that I'd take a look at as well. So communication services, last week we were short New York Times, and it paid out a little bit. It was down 3.57%. So it's still got a little bit more time on that one. I'm going to continue to hold that one on the short side. This week we're looking at Spotify, and this is in a descending triangle. And you can see how far it's come down, from over 170, and that's just on this chart. It's all the way down to the 97 area right now. So it broke support on Wednesday. It looks like what was previously supported broke it on Wednesday. And it's just continued to look weak. You want to wait for another confirmation, go right ahead. It gets below that 95 area. A couple of things you do, look at, go out to July 15. That 195 bear call is looking pretty good. I'm actually going to be looking at the August 105, this next July 8th diagonal put spread right there. That's one that I'd be interested in. Let me test drive that for a little bit. When we're so close to the 95s, you're going to get a lot of implied volatility on that one that you can be shorted. And I think that's the one that pays off. You just want to test drive this for a week. Healthcare. Last week in healthcare, we were long Dawn, DAWN. And I'm glad we were long it because that was up 12.2%. That's one of the winners that we had. This one, IBB shares, the biotech ETF. And this is a pretty strong sector within healthcare. I'm really liking this one. And you can see it in a lot of individuals. Now, we're at resistance, I would say, right now, just from previous, right there. But, give me one more update right here, and I'd be more than happy to go long IBB. ways I play it. Again, I mean, we're going to sound like a broken record on these diagonals, but that 115, 120 diagonal, I like that right there. A lot of implied volatility in there, a lot of gamma that you're going to be able to capture as well. So I just want this to hang out right about the 119.95 area for the next 4 days, and then I'd be more than happy to hold on to those August 115 calls.
In the industrial sector, last week we had Zim Shipping on the short side. This has been on my short list for a while, and it had a nice fall, down 6.6% on the week. All right, this week I want to take a look at Paychex. Now, every so often, the stock comes up. I'm like, how in the world did they decide to put it in industrials? Paychex is like a payroll company, and for some reason they are in the industrial sector. But I got to say, I actually had a hard time finding anything in the industrial sector. It's been one of the weaker sectors, and so everything in there has been destroyed. And I don't want to go long anything, but I felt like everything was too far gone to go short. So I'm looking, okay, what trade can I make in the sector? I want to have some exposure to this industrial sector. And so I'm looking to play this one sideways. And there's really two ways that you can play it. So if you take a look at the 110, 115, 120 butterfly, you're basically saying, I think for the next 2 weeks, it stays in this range. This would be the range that you're looking at. Now that is perfectly fine, but you can also do a little bit more targeted butterfly and say, you know what, I think it's going to be a little bit more bearish. So I'm actually going to go down a little lower, and I'm going to play the 115, 110, and I can't draw down to 105, but you can say I'm playing this slightly to the bearish side. I personally am going to be looking to play this one here, the 110, 115, 120. I think this is more sideways. I do think we're having a slightly up week. So, you could even make a case for the 115, 120, 125. Ultimately, I'm looking at that 115 as the target here on Paychex. In financials last week, we had JXN short. It paid off a little bit, down 2% on the week. This week, we've got DWAC, Digital Acquisition Corp. This is a SPAC, and this is a stock that is doing what I call it the March of Death. The March of Death where, something broke and it is just simply going down. And all you want to do is every time it bounces or bases, you want to get in it. And anytime it has a bounce, you want to get short. Anytime it bounces, bases, falls, bases. So look, these are hard to get in. I remember when I was a new trader, I would look at these and say, I can't short it now. And it's the same thing as, when the stock goes from 100 to 200. At 200, you say, well, I can't go long now. Well, guess what? It's proving to you that there's a supply and demand imbalance. These are the trades you want to enter, though they're very hard psychologically. And so on this DWAC, it's really just a matter of getting short and playing it in a way that you can hold on through potential rallies. Now, this stock is fairly heavily shorted. And so there are possibilities to get short squeezes. And that's really what these moves are, when they have those big moves, are really just short squeezes. So when you're playing heavily shorted stocks, you really need to be very conscious of how you do it, because this stock could easily rip higher by 10 points. I mean, this could go up to 40 with some sort of news on it. So you've got to play it the right way. You've got to say, okay, where's my risk? I'm going to define my risk. Vertical spreads are fantastic ways to do it. So the 22.25, we're looking at, you're basically going to be getting about $2.10, $2.20 in. You've got 80, 90 cents of risk. You put that trade on and you let it sit. And you know what? If it keeps being weak, you're going to make a nice risk reward on the return. If it rips higher, it's just going to be a very small loss for you. So that's DWAC on the short side.
So for consumer, last week we were sideways in GameStop, and we played that one fairly wide. Not looking too good right now. GameStop was down 8.7%, but if it bounces back up to the target of the butterfly, and just depending, did you want a narrow butterfly or a wider butterfly? There's probably still an opportunity to pull out a credit in that one. This week we're looking at Yum China, YUMC. You call it a high base, you call it a breakout. It's just looking pretty good. People are buying it right here. It broke out at 48 front. That was previous resistance. I think 54 is the next good target. The question is just how long does it take to get there? With the way the options expiration fell, we've only got, really 2 weeks in July for something to move. So this has got some legs. You could take a look at that 50-55 bull call spread. I think is probably the best way to play this. If we can get up to that 56 area, then we're good. Just how long is it going to take to do it? But there's definitely some legs to YUMC. In technology, last week in technology, we were short GFS, and this is another one that really came out good for us. That was down 15.43%. So if you got into that one, congratulations. Feel free to ring the register on that one. Right now, we're looking at IBM, and this is not one that we trade very often. But we're in a bull pullback and an ascending triangle at the same time. You can see it's been marching up, even though this market's been really weak. IBM has been doing pretty good with resistance at that 142 level. There's definitely some strength in this. This is one of the better looking tech ones right there. A little bit of resistance at that 144 level, but I think that gets blown through fairly good. So I'm looking at the August 140. I'll go long that and short July 15. Short the month of July's 145s, and I think that's the trade to make. If you wanted to have a little bit a wider profit area, you could look at that 140, 145, 150 butterfly. That's going to get you, you probably get into that for, 350 probably, but your profit area is going to be much larger than that diagonal call spread. But I'm looking at the call spread right there.
Moving on to the materials sector, last week we were short OLN, a chemical company, and it went down 2.2%, so basically went with the market. This week, Newmont Mining. Let's talk about what has happened, especially the last 2 weeks, because the last 2 weeks there's been a big change in the materials sector. We've gone from shortages and high demand to potentially not enough demand to even buy the products that are out there. And so this is gold, and this is gold mining. And gold has been an inflation hedge for years. It really hasn't worked all that well lately. But I tell you what, it's really worked well with. When deflation hits, gold falls. And so look, I'm not saying we're going to get deflation, but we're starting to see potential cracks in this inflation story. And gold, I think, is the prime target. If we do back off of inflation, I think gold is really doesn't make any sense to anyone whatsoever. And you can see the chart is reflecting this. The chart is showing us that, gold is not really in demand at the moment. And we broke down below this support. And so the question is, okay, where do you get short? How do you get short? That's really the question. What is the duration to be short? So let's talk about potential trades. I like this one, just 2 weeks out, 60, 65. So basically I'm saying I think it's going to be below 60 within 2 weeks. I'm going to wait 2 weeks. I'm probably going to get in about $2. So I got a $2 upside, $3 downside if it does blow up past 65. But I've got 2 weeks just to let this do its thing and fall below 60 by expiration. In energy, we were short EQT last week, down 2.3%. Again, another small winner. This week, Suncor. When I looked at energy, I don't really know whether to be long or short. And Darren, you hit it right. You had a zero. I think energy is going to be up big some days and down big other days. And I think it's going to be a very wild ride. I think it's very difficult right now. I actually think the hardest trade to make right now is the energy sector, because there's lots of forces moving it around, but it used to be in one direction. Now it's not. Now it's directions all over the place, and it's really based on just 2 days up, 3 days down. You can see the choppiness that we've seen over the last 2 weeks. So I'm looking to play this sideways, and this is going to be a pretty wide butterfly, but you'll see that with the volatility of this stock, it's going to pay off nicely. So I'm looking at the 30, 35, 40. So basically, this is my range. My break evens are going to be somewhere in here. As long as it sits in this area for the next 2 weeks or closes in that area, it's looking to be a nice trade. I do think that the energy sector is a tough trade right now. And if a trader of mine said, hey, Rob, I'm just going to take a pass on energy and play everything else, I'd say, good job. That's a great job. So that's my call on energy here. So to wrap this up, we do see volatility coming out of this market a little bit. We had this very intense movement 2 weeks ago, big bounce back. And now it just seems like people are settling into, yeah, this market stinks, and I'm going to go out for the summer and do something else. I feel like that's the vibe right now in the market. So not bullish, but not panic bearish either. So ultimately, we do think the next major move is lower, but we don't think it's anywhere imminent this week or next week. So keep making your trades, keep following the sector's top-down approach. Make sure that you are diversified in your basket trading, and just, again, do everything correct. That's just it. That's it for me. Thank you so much. Everyone have a great, great weekend. Stay safe out there, and happy 4th of July, everyone. Goodbye.
Happy 4th, everyone. Good trading.